We start the show with a round table this evening, and our guests are Sarah Wadham, Director General at the EIS Association, and Paula Steele, Managing Director at John Lamb, and Paul Winston, Managing Partner at IFA Magazine. Welcome to the show.
Thank you. Thank you.
So, Sarah, if I can start with you, EIS in some ways the envy of other countries around the world, and particularly the Americans, and clearly a very effective tool, but as I understand it, there are some changes afoot in terms of what's going to be eligible and not. From my own experience in renewable energy investment, that's certainly gone by the wayside. So can you give us a quick update in terms of CDIS and EIS and how it can still be used?
Well, the main changes which we're dealing with at the moment were the result of the EU renewal of the EU state aid guidelines. So the EIS and SEIS all come under the umbrella of Brussels. And the direction of travel in Brussels is very much to encourage investment into early stage and start-up companies, and not so much in middle market companies, which is slightly short-sighted in a way, because if middle market companies can't get funding, this early stage and start-up ones, when they start growing and developing, will fall off a cliff. But we have to work with the rules as they are. The main changes are really about the age of companies. So there are big restrictions now on companies older than 7 years. I think the feeling in the EU and in HMRC is that by 7 years companies should be self-funding and have weaned themselves off state aid finance. This is slightly naive because there's an assumption that there is plenty of capital out there, free capital not with state aid advantages, and this is not exactly the case. So we've set up actually an ESA, EU state aid committee, to go and talk to Brussels about the fact that we need to support the middle market. And this is very much what comes from Brussels under the direction of travel for most of the EU and the Capital Markets Union initiatives. They want to support the middle market, so we're hopeful that this will continue.
And also the amount, so the cap has increased fairly recently in terms of, is that slightly contradictory, that the amount you can raise is higher?
Well, I think the amount is not so much the problem as the detailed rules on companies more than 7 years old, and actually what younger companies who have got EIS funding. SEIS is slightly out of it because it's only £150,000 and it's called de minimis, which is not really regarded by the EU. They don't get involved with that. So SES is unchanged, but in reality, no 7-year-old company is going to be raising SEIS. So this is really good for very early stage startups. But the 7-year rule is quite a problem because companies often take longer to develop than 7 years. And the other problem is that there's this limitation on what companies can do. So in terms of acquiring other companies and things, it's all working its way through. I think it is just a question of adjusting to the new rules, but it is more of a constriction than we had before.
Well, I'm glad we've got you in there, being the voice of the investor in the
what's
UK.
so great is that this has brought all the trade associations together. So
gosh, that's an achievement.
It is an achievement.
Yes.
So we have the BVCA, which is venture capital and goes down to the sort of later stage investors. We have us, the EIS Association, which represents the EIS fund managers, and we have the UK Business Angels Association. So we are all, and the AIC, who represent the VCTs. So all of us are on this joint committee to talk to Brussels about supporting the middle market, because this is so vital for SME growth.
So from an EIS and a CDIS in particular point of view, I mean, it's proven to be a very effective tool, certainly from an equity crowdfunding perspective. You know, more than 80% of the businesses raising money have that there. From an advisor's perspective, Paula, I mean, is it possible to get an advisor to take a look at an EIS investment? When can that work, and when is it problematic?
I think it's problematic if you're trying to look at just an individual company. We don't have enough time and not enough budget to do the due diligence properly. And if you're going to do the due diligence, you do it properly. What we can do due diligence on is EIS funds. So where you've got a fund manager who is managing investments in early stage companies. the tax benefits are the same for the individuals, and they have got somebody who is doing that due diligence, who is selecting the funds, and we can do the due diligence on the managers, because they will then have a track record and we can see what they're doing, or in some cases not doing. But at least we then know what we are able then to say to a client, these people have got a track record, this is what they've invested in, this is what the outturn has been, and we think that's quite a good result.
Interesting. Now, with the growth of crowdfunding, and I'm going to come back at the end of the show to talk about some of the stats that just came out, but there's a mix there of people deciding for themselves what to do with their money and people using advisors. And one of the requirements from the FCA is that at the start of the process, people have to put themselves into a category. We're all familiar with those, the first stage on a site where you're either a high net worth individual, you're sophisticated, you're one of the new restricted investors, which caps you at 10%, or you're advised. And I've heard lots of platforms, almost giggle and roll their eyes and go, well, that's never going to happen. Do you think there's anything which we could do to make it more advisable, given how huge the influence is of IFAs across the country and how much money they can potentially move around?
Probably not.
I'm thinking
I think the difficulty is that as an IFA, I sit there with a regulator behind me who is very concerned about clients putting money into anything with any risk at all. They would prefer people to make their own decisions about that because they feel, whether correctly or not, that I might influence people to buy higher risk investments. And even though there's no commission bias and all of the rest of it, and even though the stupidity of it is that, for example, if I buy CDIS for a client or EIS, I'm not able to take, in terms of the return to that client, the tax benefits into account. Yeah. So that from my perspective, they're buying an EIS company on exactly the same basis that they're buying Shell, and without the tax benefits being taken into account as part of the return.
Perfectly into you, Paul. Now, having read a little bit of some of what you've discussed before, what's your view on this balance between people actually leading with the fact that this is a tax-effective investment rather than looking at the underlying company itself? Where is the balance? Where should that be?
Well, I think historically the balance has always been it's about the tax.
Yeah.
And if you go back a number of years, the thrust was all about getting risk-free investment underneath the radar. Right. And that really hasn't helped the industry particularly, because this was set up to raise funds for early stage businesses, which is what we're discussing. The government has leveled the playing field now. So they've said, look, this is only going to be for risk-based investment. So the question we're really looking at is, what are the fund managers doing? Because it's all about what you're actually investing in. It's that underlying question of where are the assets, what assets are you allocating to? And the fund managers are superb at that, but their message has all been really clouded in the, let me tell you about the tax, and it's very hard to differentiate yourself. And there has been a temptation, I think, with some advisors just to talk about the tax, and as an afterthought, I think that's in solar. Whereas what we're looking at now is, let's have a look at the sector, have a look at the allocation. The fund managers are really, really good at weeding out the bad pitches. They can do the due diligence, they have the experience to do it. They have committees of people who really understand sectors. So you're starting with the person most likely to win before you get going. So what we're looking at is really helping the industry present that side of the business. So it's looking at what are the funds doing, what's their expertise, and it's getting around that due diligence issue, because I think the temptation as an investor is to try and invest directly with the guy you met in the golf club or down the pub, or your brother's cousin. He seemed like a jolly nice bloke. And the problem is that you don't.
He probably
really
is a jolly nice bloke.
Probably is.
That doesn't mean he's got any ability to run a business.
and that's the real problem. So, for my money, I'd like to have a fund manager who gets up every morning and whose living and livelihood depends on getting this right. And it also helps spread my risk.
Yes, I think that's part of the value of doing it through a fund. I guess the counter argument in terms of the equity crowdfunding side is that you can get your money directly into a project. And there may be people who are less experienced on the investment side but know a particular sector very well. I mean, I think there is a phase of life that you get to where if you've been fortunate enough and done well in business, it's actually quite uplifting to be doing early stage investing and supporting those
Absolutely,
businesses.
and I think there is a place for that, particularly because the investment amounts are a lot smaller. So you can speculate as little as £1,000. That's quite different to putting 25,000 in as a minimum.
Yes.
So you can spread your risk. You could do 25 companies, and if you're looking at 3 or 4, doing okay and one really good one, that kind of spreads your risk. But you're being your own fund manager, and that's fine if, as you say, it's somebody. I've been playing the game all my business life, and now I want to do this for fun. But if you're a bit younger and sort of thinking, right, well, I've put this together. I say that it's really hard, but that bit, I know it's high risk. I know I could lose the whole lot, and I want to play in a sector. That's where the fund managers come.
Yes,
I think the other thing that fund managers do, it's not just about choosing the companies in the first place, which is really important. It is about the ongoing relationship with the companies. They sit on the board, they introduce people who can help the companies, they guide the companies if they're going a bit off track. They're available with further following on funding. So you have got someone looking after your interests. It's very easy for companies to take people's money and then forget all about the investors. It's really important that there's an ongoing relationship between the companies and the shareholders. And if you have a fund manager in place, they manage that relationship for you.
Absolutely. Together with the exit, because that's the other thing, is every investment's easy to get in, it's much harder to get out.
Absolutely.
And this is really where the fund managers come in, because you've got further funding tranches if it goes right. And you have to get that right. You have to get the money. And then you need the network, are you going to float, you're going to do trade sell, how are you going to exit? And for somebody who's starting out, particularly on the seed side, that's great. Well, I got my 150,000. I'm not equipped with the skills to do all of those things. I'll never have done it before, and I need people around me, and that's where the fund managers are really coming
I think it's interesting, the first one in some ways can be the easiest, and for a lot of businesses with real ambition, that 150k is not going to last you particularly long. And I think that can be some of the issues that kind of follow on. But if I can just come back to this idea about risk behind it, because sometimes it feels like risk is a dirty word, and nobody should be taking it. And you made the comment, Paula, that in some ways the advisors are saying, gosh, but we've had a conversation previously, and you said actually you would actively encourage some clients to be looking at EIS investments because you think it could be part of a portfolio, or do you feel it's just not appropriate for certain levels of investors?
Well, it's not appropriate for certain levels of investors, I think, but it is appropriate for other levels of investors. I think anything that's going into early stage, even with the tax benefits, the clients have to be aware that they could lose all of their money. It is unlikely, in reality, if you invest in BP or Shell, that you will lose all of your money. It might go down in value, it might go down quite a lot in value at the moment, but you are unlikely to lose all your money, and even if it goes down because of the oil price and all the rest of it, it will probably recover. Often with an EIS, if it goes down, it's gone.
You do get the tax breaks. You can offset the loss against your tax. So you only actually lose 38p in the pound, but you still lose 38p
Absolutely.
in the pound.
But this, to your point, Sarah, this is the direction of travel. I mean, that was my understanding, is the EIS is supposed to be a form of compensation for the risk in some way.
It's for risky companies. Why are they giving such generous tax breaks if people aren't taking risk? And this is solar's slightly different because that was an industry that became established and didn't need help anymore. The real philosophy behind this is to direct this state-aided funds towards the companies that need it most, and this is not companies with no risk or companies where the managers are just stripping out the tax breaks. This is against the whole spirit of the scheme and not something we support. This is to support early stage companies, and it's fine. People who have, people are allowed to go to the racecourse and put money on Max Head in the 315. If they want to put some of their money into supporting early stage individual companies, that's fine, but they need to know the risk. What we're talking about with the financial advisors is longer term investment of savings and things. They're not mutually exclusive, they're just different, and people need to recognise that. So it's great. If you've got a local brewer who's really good fun and you want to put some money in, why not? And you probably don't really care too much what the outcome is, you want to be involved in that business.
Yes, and I think that there is that blend sometimes of just loving the business or loving the idea and wanting to back it, and I use the word back advisedly. But I think it's also a good opportunity, as you said, Paul, because the investment amounts can be so small these days when you're investing through crowdfunding and platforms, you can actually learn a lot from your own experience of doing it, and sometimes there's no replacement for putting even your 50 quid in and actually seeing how it works out.
Yeah, well, that's the thing. I mean, and I think there is a difference between sponsoring somebody, you know, saying, oh, it doesn't really matter if it falls over in investing. What we're really talking about is investing. And that's where that idea of spreading your risk, because it's quite binary. If you back one company, it's either going to succeed or it's going to fail. You back a number of them, particularly if the amounts are smaller, or you're doing it through a fund, your risk is mitigated to a degree. Effectively, the state is investing alongside you. They're backing your judgment. So I view it less as a tax break, but more as having a co-investor. And if you think about it in that way, it changes the whole dynamic of it. So it's a serious investment, and it's about picking the winners. But these companies will go on to be the big companies of the future. But if we've got one Google, there was an awful lot of people started out on that particular track.
The inherent search for a unicorn. We've yet to have a female unicorn, apparently, which is quite upsetting. So maybe we'll get around to that next week. So one of the new things emerging, I think, in the market this year is we are finding things like the crowd rating product, All Street doing research reports, and this idea that there could be a third party who is paid neither by the company raising money or by the platform, who is trying to give a research-based opinion behind it. And that has been the way of the world, hasn't it? That advisors have been keen to have independent advice. So could that not be something which might be of value if it's set up in such a way that the company raising early stage finance has an independent report? Would that make any difference in terms of how advisable they become?
No.
No.
And the reason I say no is because if I'm sitting there and advising a client, I have a regulator behind me, and although I will say to a client, this has got a rating on it, and we will rate the raters, for me to do that piece of advice that says, I recommend that you invest in
that particular one.
In that particular one. Probably my professional indemnity insurers would blanch, but the regulator has massive issues. I think that from the perspective of government, which wants money to go into early stage companies, which creates jobs and are the companies of the future, and you've then got a regulator who would prefer you not to do any of this type of investment, not to do any kind of recommendations, even if you are recommending into an EIS fund, you've got quite a lot of hoops to go through.
But there is something of an advice gap now, isn't there? In post-RDR, we do have, a fair number of orphans. Now, maybe they're not the guys who will do a lot of the early stage investing. But, George Osborne is so keen on this early stage. He's so keen to get the money flowing into the early stage businesses because those SMEs could well be the engine room of recovery. So, we've got a slight contradiction there in terms of lots of signals coming out from the Conservatives that they really want these businesses backed, and yet there's challenges from a regulatory perspective. I mean, how do you see the world as being different pre and post RDR? I was not in financial services pre RDR, so this is the only way I've ever known it.
Well, pre RDR, we were going to be paid a commission.
Yeah.
And actually, we probably charge as much today to cover our regulatory thing as we were probably getting in commission. It was, you never got that much in terms of commission, not in terms of EIS, and there was some sort of odd bits that would pay lots, I think. It wasn't our world. But in terms of that, you were being paid by the product. You weren't having to tell the client, I'm going to earn this. But I think more than that, I think I work in the IFA sector, and in the IFA sector, you're having to look to make sure that your advice you're going to try and make a profit on. And if you look at the amount of time that has to be spent relative to what you're going to have as an earnings line, it's disproportionate.
But is there a middle ground there, though, Paul? Because could it be the case that, if I'm an investor who's got an appetite for this kind of thing but would like a bit of a steer, that my financial advisor might at least say, maybe 5% of your portfolio could go into this kind of area without
Oh, yes.
specifically looking at
Oh,
the
yes, we can
conditions?
definitely say that.
Yeah.
We would say that. We would say that, and we would talk to them about the tax breaks.
Yes.
But then you're either going to push them into a fund,
Yeah.
because that we can do the due diligence on. But otherwise, if it's an individual one, we can send them to a platform.
Yeah.
So you might like to go and look.
Yeah.
We can say you might like to look at these rating agencies,
Yeah.
but we won't then do the recommendation.
You have 30 seconds to close, Paul. Your view?
Well, I think that's the way of the future. You know, it's about the asset allocation. So if we sit with all our clients and we say, right, 5% for you
Yeah.
needs to go into this sector. Now it's a question of how do you access it? Put that in through a platform, put that in through a fund, and put that in through your mates down the pub. Back that horse. But that's where recovery will come from.
Excellent. I'm looking forward to backing some more horses. Thank you so much for all your time. I really appreciate you all coming in. Sarah, Paula, and Paul, thank you very much.